Happy Monday, everyone. Welcome to our meeting. I'm Linelia, one of the directors of Monday meetings.
Yes, and I'm Dr. Wanwi, and we are excited to have professional from pension insurance today to talk with you all.
Before we get started, let's see the announcements for this week. So later today, we have the alumni panel from 5 p.m. to 6:30 p.m., where you can ask your questions to the previous CSUN alumni who work in different firms right now. And then this Wednesday, we will have CLA. They're going to talk about their firms. And then this Saturday, we will have our AA hike to the Hollywood sign. Please sign the forms if you want to participate. We encourage everyone to have their cameras on, and please wait until the end to ask your questions with the raise hand feature on Zoom. Without further ado, please feel free to take it away.
Okay, so right now we will have Scott Mueller from Pension Assurance. He will present to us on about saving for your future. Okay, Scott, it's your show.
Perfect. Thank you for that introduction there. Hi, everybody. I'm happy you're here. Means you're interested in saving for your future, saving for your retirement. And honestly, this is all information that they don't really teach in school. So this is all things that you're going to probably hear in passing, just through life, just through experiences. And so the idea of this is hopefully to just cover on certain, retirement saving vehicles that are out there, and also to kind of show you how these work, share with you some scary statistics, and also, let you know on certain retirement vehicles that you may not be aware of, and just things to keep in mind. And they're good to communicate early rather than later. So let's go ahead and just dive into this. Overview, I'm gonna do a quick plug, tell you about pension insurance, what we do, kind of give you a little background on you, pretty much why we're experts in this area. We're going to talk about the importance of saving, and pretty much, just as I said, all the different vehicles that are related to saving for your future. So pension insurance, just real briefly, we're a pretty small firm. We're up to about 40 individuals now, but we are growing very quickly. So I'm gonna say we're probably getting into that mid-sized firm category pretty soon. We'll probably be over 50 individuals going into 2022. This is our hiring season, so we're looking for new full-time staff, seniors, managers, and onwards, even some interns. So during 2021, we did over 700 retirement plan audits, making us the second largest retirement plan auditor in California. I don't know, those of you who may not have known about pension insurance, that is crazy, knowing that, I've been here for over 5 years now, and I started when the firm was small, when it was just 8 of us. We were doing 125 audits back then. Now we're within 5 years, we're doing over 700. That just kind of speaks to our growth and the success that the firm has experienced over the years. And so definitely something that we're pretty proud of, and just speaks a lot to our firm. Quick background on me. I'm a CSUN graduate. I graduated back in 2014. Went to EY immediately after graduating for a couple of years, did the Big Four thing, wanted some work-life balance, and so I came back to pension insurance. I was a member of Accounting Association, as well as VITA Office I and MISA also, and I did both the accounting and information systems double major back then. So I recommend it if you are interested in that also. I use my information systems knowledge constantly. Okay, so getting into this, the power of saving now. I'm sure you all know this, the power of compound interest, right? Albert Einstein once said, compound interest is the 8th wonder of the world. Those who understand it earn it. Those who don't pay it. So this is very real. This is a very real statement. And this is obviously something that you all understand from your finance classes that you're taking, that you're required to take. So just simple, vague idea here. So $10,000 Annual interest rate 7%. That's pretty much like your weighted average market over long term for investments. 20 years, 10,000 becomes $40,000. 40 years, $164,000. So those of you in your 20s, if you're going to be retiring at 65, if you can get $10,000 in there, that's $164,000 later. That can be pretty great. And then obviously more compound interest and everything goes from there. I won't go into those details. So why is saving so important? Well, let's look at Social Security. This is really the only government provided retirement that is provided to you, just being a citizen in the United States. In 2021, Social Security is operating at a $147 billion deficit. That means there's more money being paid out than there is available in this trust account. It's expected to become insolvent in about 12 years. And what happens when it becomes insolvent? People's payments are going to be reduced by 22%. So, you know, you probably heard it before that you can't really depend on Social Security to be a form of retirement. People can't really live off of that anymore. And so things are only going to become more expensive due to inflation. So now we're kind of sitting here. I'm in your generation where I can't depend on this to become my retirement plan. I can't depend on this to pay for anything. So here's a little chart for you coming from the Social Security Administration showing that point of insolvency. We're all accountants, we can see that payable benefits, but they don't have enough revenues to pay those benefits. And it looks like it's just gonna flatline there unless something happens. And I'm not feeling too confident there's gonna be any change in this. And I have a feeling that that 22% benefit cut is likely gonna happen. And so really, I'm looking at Social Security as a supplemental retirement when I get to that point. But this is why thinking about it, saving now is going to be important when it comes time for all of us to retire in, you know, a few years. So how do we do that? Well, there's retirement plans. There's both defined contribution, defined benefit plans. These are company sponsored plans. So this is something that you can look for when you're going after you graduate and you're looking for what career you want to dedicate your accounting career to. Individual retirement arrangements, health savings accounts, and then there's a Coverdell education savings account. So we'll kind of talk briefly about all these in detail also. So how are you going to start saving? Well, there's different kinds of retirement plans, and this is where pension assurance specializes. We audit all of these plans that are considered large and hosted by your big companies that have more than 100 employees. I'm pretty sure there's some of these retirement plans that you've probably never heard of, and so that's fine. I'm going to explain them how they go. But 401k, I'm pretty sure you've all heard of. 403b, we'll talk about those too. There's ESOPs, money purchase pension plans, your traditional pension plan, and then a cash balance plan. There's also some health and welfare plans, but those are really specific, little different, and they can be good sometimes. All right, so let's go for your 401k plan. In case you haven't heard, 401k plan is pretty much a company-sponsored retirement plan. They usually offer these to attract talent. There's usually some nice arrangement to it to where the company is going to match contributions that you put in. And it's an effort to help you save for your retirement savings. A 401k plan can be opened by both a public company or a private company. Even not-for-profit can do a 401k, but we'll touch into that in a second. And then the 401k plans offer pre-tax contributions. So this is good when you get into the higher tax brackets. If you're trying to, put some money away to push down your tax bracket a little lower, The idea with this is the government incentivizes you saving for yourself, so they provide you with the tax-free contributions to reduce your taxable income. The idea is if you can save for your own retirement, then the government isn't going to have to take care of you later. And so this is usually why the government allows for this tax-free idea. Roth contributions, you pay your taxes now, but it is going to be tax-free when you withdraw later. So this is always kind of the argument or question, not argument. This is the question I get constantly from my friends and family. Do I do pre-tax or do I do Roth? Right? I'm sure you're all wondering that same question too. My answer is it depends, and I don't know. It's kind of up to you. So yeah, if you're talking to, every time I say it depends, I think of Professor Weiss. So I'm sure you guys think the same. But I think it really does depend. I'm sort of on team pre-tax for specific reasons. But I think both are very reasonable arguments, and in the end, it's going to be fine. Yes, so that's all I'll say about that. But there are options on savings, and they're all kind of dependent on what you'd like. And we talked about the employer matching and profit sharing contributions also. So profit sharing is actually really nice if you can find a company that is willing to do that. That means you don't have to participate in the plan. Just simply being an employee of the company means that they're going to just put money, employer money, into your account for you. So if you find an employer that's saying, we provide an annual profit share, that is free retirement money that the company is putting into your account for you. A 403B plan. So you probably haven't heard this, and obviously these numbers 401k, 403B, these are all references to tax code. So if you were to look up Internal Revenue Code section 403B, you're gonna find, you know, specific definitions on how these plans are supposed to be operated and what's going on. A 403B plan is pretty much identical to a 401k plan. The only specific part about it that's unique is these are only for your not-for-profit employees, so your tax-exempt companies. They also have some very unique rules that are also need to be followed. So things that are unique about them, they have something called universal availability. What that means is if you're an employee of a not-for-profit and they have a 403B plan, they have to do requirements such as you need to be notified, you need to have equal opportunity to participate in the plan. Usually there's no eligibility requirements where you know, you don't have to complete a certain amount of service. Usually there's no age requirements. And the only reasons why you might not be able to participate is if you're, say, like a part-time employee or an exempt employee, meaning maybe you work for a union or something, and then at that point they can kind of exclude you. But it's very unique. The whole point is that everybody who's a part of this not-for-profit should be able to benefit from this plan. So those are your unique rules for compliance. Otherwise, it operates very similar to 401k, and they're good plans. All right, let's talk about an ESOP, Employee Stock Ownership Plan. So this is kind of a unique plan where instead of, say, the company offering money, matching contributions, or profit sharing contributions into the plan, they're going to provide you with shares of their company. The idea and background behind this one is those shares of the company become valuable at some point. And companies, I know employers like doing this because what it's supposed to do is supposed to incentivize you as an employee to work hard for the company, realizing that your retirement, the company's success, is also attached to your retirement account success. So the company shares are only going to go up if the company is successful and gets valued more. So there are plans where only there's employer stock in this. So you're receiving value based off of the company's success. There is variations of an ESOP. It sometimes gets called a KSOP, where it's a 401k and an ESOP combined, where you get to put in your own money as well as the company putting stock into your account for you. So these distributions can be rolled to an IRA or another retirement plan. We're putting that in there just because it's a little unique. So sometimes these company shares are, aren't really able to be purchased in any market. So if you're working for a private company, you can't just go to the stock market and say, I want to purchase 10 shares of whatever company I'm working for, especially if they're a private company. And so what happens if you terminate? There is some transferability to that if the plan allows for that. So, okay, let's jump into a money purchase pension plan. So these are becoming a little bit more popular these days, this as well as the cash balance plan, which we'll talk to. And the reason why is because your traditional pension plan is starting to die out. They're starting to disappear. And the reason for that is that they're really costly for companies. And sometimes if the market isn't doing well, or if the market is doing too good, it can penalize the employer, and they become really hard to manage and expensive, and can put the employer in a bad spot. So they have these other plan options that employers are starting to close up their pension plans and transition everything into these new vehicles, fairly new, I should say. A money purchase pension plan is employer contributions only, so you don't have to worry about putting any of your own money in there. And it's similar to a 401k plan, where it's a defined contribution plan, meaning there isn't going to be any specific benefit that happens at the end. It's just whatever your account balance is at the end when you retire, that's all you get. That's how much money you have at the end of the day. So you terminate, the employer isn't liable for anything. It's just whatever's in your account is what you get. But they're usually pretty generous. So they are generous in the sense of they operate like a defined benefit plan, where they're going to have some formula. So if you work for 10 years, they're probably going to be like, okay, we're going to give you 5% of your annual salary, and we're going to be putting that contribution into your plan every year. And it's just going to keep amounting and amounting and amounting. And so the idea is, if you continue to work with the company, your salary is going to continue to increase. And so you're going to get a bigger profit share each year. And it works very similar to profit share. And so that's why I'm calling it that. But in general, it's a discretionary formula the company offers. So they're going to say, longer you work there, maybe the older you are, the closer to retirement, the more money the company is going to put into your account for you. Since it is a defined contribution plan, there are certain limits on what the maximum amount of contributions can be put into your account at once. I think that limit is around $56,000 right now, but it keeps going up by about $500 to $2,000 each year. So you could potentially get a maximum $56,000 contribution into your account if you're part of one of these plans. Okay, let's talk about our defined benefit plan. So if you remember, probably from your accounting 352 classes, there's the defined benefit plan. So these are your plans where you're doing you're amortizing your service costs, you're doing your corridor rule testing, journal entries. Good news, in the real world, accountants actually don't do this. You don't have to do any of those journal entries. There are companies that do this stuff for you, but for some reason, us as CPAs, we need to know it. Plus, we get tested on it on the CPA exam occasionally. So, here we go. And I've never done any of those journal entries, but I still remember it because that information was hammered into my brain. So a pension plan is pretty much exactly what you probably have heard and imagined. So these are going to be your old unions that have a pension plan, your old hospitals from like 30 years ago. And the idea is, you know, instead of whatever is in your account at the end of at retirement is what you have, it's you get a lifelong benefit when you retire. So just an example, a defined benefit could be like, we're going to take the average of your last 3 years of employment, whatever your average salary is for that, and we're going to pay you that salary every year for the rest of your life. That could be very, very generous, very awesome. So say you're close to retirement age, you're making $200,000 a year, and that's your average. That means every year until you retire, you're making $200,000 a year, and that is the company or the hospital or whatever you're working for that is going to pay that for you. That's crazy. It's also expensive, but that's how they work. You don't find these very often anymore. They're starting to die out because, like what I said, they are expensive. Companies are realizing that they can't keep up with the growth, and so these are starting to die out, and they're being replaced by that money purchase pension plan I talked about earlier, and as well as the cash balance plan that we're going to be going into later. All right, cash balance plan. So again, similarly, this is a pretty much a defined benefit, but it's a little different in the sense that rather than a formula of what your payments will be at the end of retirement, they're going to use a similar formula to a money purchase pension plan, where they're going to be like, okay, you've worked with us for 10 years, so we're gonna credit your account with $10,000, and that $10,000 is going to grow with market value, and in the end, you're going to have a certain specific account balance, but it's not actual cash that's in your account. It's just a record-keeping representation of how much you've earned over the period of your service with that company. So it gets a little confusing because you pretty much have your account balance that starts sitting here, and then you also have the plan. And so the company isn't dumping money into your account. The company is dumping money into the trust to pay for everybody's accounts once they become retired. So it's a little confusing, a little bit more tricky, especially from the accounting side of things, because so what we have to do is, or as an auditor, we have to make sure that there is enough money in the trust side to pay for the people that are inside and have earned benefits. Unlike the money purchase pension plan, it's not a limit to how much you get. The company is still liable for how much you have sitting into your retirement account when you retire. Sorry if my thought process is a little all over the place. My mind's moving like 100 miles a minute right now. And if you don't understand what's going on, that's okay. I expect a lot of it to fly over your head, and that's okay. My whole point and objective is just to get these names out to you. So if you hear it, you're going to be like, oh, I remember something about that. And just a cash balance plan is typically one of the more generous plans too. It is all employer contributions. So it's pretty much free money that the employer is putting towards you in the end. And they can be very generous by the time you retire. Okay. So those are company options that are provided to you. What if you are an entrepreneur or you start your own company? How do you save for retirement yourself? right? Maybe you aren't going to open your own 401k plan or your own cash balance plan. The first thing I want to point out also is individual retirement arrangements. Oh, actually, let's not talk about that yet, because I have a note for it. So you have two types, a traditional IRA or a Roth IRA. These are available to anybody who wants to do it. You could do it anywhere. You can go to your bank, you can go to your credit union. There are big wirehouses like your Charles Schwab, Merrill Lynch. They're gonna be happy to open up these things for you. And it's just a way of saving for your own retirement. I just want to clear something up here. The A does not stand for account, it stands for arrangement. I've heard it 100 million times from people, like individual retirement account or Roth individual retirement account. It's not an account, it's an arrangement. My mother does this to me all the time, and it's very painful. So let's just get that out of the way. How much can you put into these things? Well, you can put, right now you can do $6,000 a year. If you're over the age of 50, you can do $7,000. So that's not nearly as much as you can put into a retirement or a 401k account. Those limits are up to $19,500, about $20,000 now. So you kind of have, you know, a give and take, and you can only take advantage of what's available to you. You can contribute to both an IRA and a 401k account. And so if you are in that, obviously this is all theoretical. I don't think any of us are in that income level where we can hit the maximums, but you know, we can dream in one day. But you know, this is information that, you know, maybe you hit the lottery and you got to put money away tax-free somewhere, and this is, you can hit your cap limits, and that's what's going to happen. So and they work very similar to 401k accounts. These items are not going to be taxed until you pull money out. This is just some more facts about IRAs. You have those limits that we talked about earlier, 6,000 and 7,000. Those could be limited if you are in that tax bracket that we're all hoping to achieve one day. So if your AGI exceeds a certain amount, you might not be able to reach your full tax bracket amount or tax limit. And also, if you have a taxpayer and spouse who are covered by a retirement plan at work, I think there are certain rules. I know we talked about the limits on that earlier. So this is something interesting that I did when I was reviewing the slides here. There used to be an age limit, so you could only put contributions into the plan up to age 70 and a half. Why 70 and a half? I don't know, but that used to be the limit. But with the CARES Act that passed during the pandemic, they took that requirement away. So you can actually put contributions into your retirement account all the time, which is, again, one of those unique situations that we're all going to be more concerned about later when we get close to retirement age, but there's the knowledge. So a Roth IRA, similar to how Roth contributions work. Those contributions aren't deductible because they are taxed already when you put them in. So you can't really deduct it already since they're after-tax contributions. Qualified distributions are tax-free. So let's break this down. The word qualified. Qualified means anything that's within, meets the certain requirements of the rules. Qualified in terms of retirement plans means tax-free. Means you're not going to incur a penalty. It's meeting certain requirements. So a qualified distribution would be a rollover distribution. You're allowed to roll that money into a different account or into another retirement plan. And so because it's meeting certain qualifications and requirements, you don't get penalized or taxed for that. So that's what we mean by qualified distributions. QDRO, we call them quidros or quadros, depends on who you're talking to on that. Anybody know what that is? That's a good sign. It stands for Qualified Domestic Relations Order. That happens typically out of a divorce, and you say your spouse has a retirement account, and you were married to somebody and they were your retirement plan. This is kind of how the state plans on this. You might have an arrangement where you have, for sake of our example, say you have the wife that's the breadwinner and she's out working, and then you have a house husband and he's at home taking care of the kids, doing the laundry, cooking meals, and so he's depending on his wife for retirement. But then things don't work out, they divorce. What's going to happen? So the court in California, as well as all the other states, sees, okay, well, assets usually get split equally, including retirement accounts. So a quadro will basically be an early distribution from the account, ordering money to be moved into the other spouse's, ex-spouse's account also. So that is also a tax-free distribution. Contribution limits are the same as traditional IRAs. Yep, so same stuff. So this was also a unique thing. We were talking about the age limits on how late you can do contributions into the plan. With a Roth IRA, there was no age limit. You could keep putting money in because you know what? The IRS is getting paid anyways. They still get their taxes on those contributions. Even before 2020, this was applicable, so there was no change. So there you go. Amounts can be left in Roth IRAs as long as you live. This is something I'll use my mom as an example. She keeps saying that she wants to keep money into her account so that she can leave it to her children when she goes. And so maybe you're going to be on that mindset where you're like, I have enough money, I just want to take care of my kids. You could leave it into a Roth IRA. Keeps it protected. It's investments that can continue to earn money, and it becomes assets that get split. All right, health savings accounts. So, Ani, I see a hand. You got a question?
Hi, yeah. Could you explain a little bit about the backdoor traditional IRA to Roth? Like, how is it beneficial tax-wise?
Sorry, say that again. A backdoor beneficiary?
No, the backdoor traditional IRA to Roth. It's like you input money for traditional retirement account, or sorry, yeah, for the traditional retirement, but then you like end up with the Roth benefits. Does that make sense?
I see what you're saying. You're trying to do like an in IRA conversion to Roth. Yes?
Right, yes, that one.
Okay, yes, okay, yeah, so it's called a Roth conversion. Typically what happens, and you can do that, you can make an election to convert one time all of your pre-tax money into Roth contributions. I think it's going to really depend on who's hosting your IRA account, where you talk to them and say, I'd like to make this conversion. Obviously, once you do it, you can't really go back. You can't make tax money pre-tax again. So, but yeah, it is an option. I have seen it. Sometimes it happens in 401k plans that we audit where they'll do a Roth conversion. And yeah, it's just an option. It's just something that you do. And I think you'll get reported the tax benefit, all that money gets taxed. You'll have some sort of withholding. And then you'll end up paying that tax to the IRS on your tax return.
Okay, perfect. Thank you.
Yep. Hopefully that answers the question.
Mm-hmm.
But, yep.
Yeah, thank you.
Yeah. Okay, a health savings account. So a taxpayer with a high deductible health insurance plan and out-of-pocket limits. So health savings account is something that taxpayers can usually only take advantage of when the plan options provided to them has a high deductible plan to them. So it's a tax-free way of prepaying for your health costs. So in order to meet the requirements of having an HSA account, the deductible, and I know insurance can be confusing, so I'm trying not to get into the vocab of insurance stuff, but your deductible has to be fitting within these certain ranges. So it can't be less than $1,400, can't be more than $7,000 deductible. If you're getting coverage for yourself, $2,800 to $14,000 for a family. So as long as the deductible is within those ranges, then you're eligible for this health savings account. And again, like what I said, it's a way to take part of your paycheck, put it away pre-tax to pay for medical services such as your doctor visits, prescriptions, anything medically related. So if you need crutches, those sort of things, you can pay for that too. And then there's your contribution limits for 2021, $3,600 for yourself, $7,200 for your family. I'll just mention it. I'm not going to go into details. There is also something very similar to this called a flexible spending account, an FSA. It works similarly, but the key difference is what happens to the money after. And also the FSA doesn't require a high deductible account or a high deductible plan that you're participating in. But let's focus back on the HSA. Personally, because I think it also can be used as a retirement option, and we'll talk about this in a second. Are you all ready for a scary statistic? I'm not. Approximately 2/3 of personal bankruptcies cite that medical bills are part of the cause why they went bankrupt, even though they were insured. I mean, I could have guessed it. I didn't want to know the answer, but I Googled it and did my research, and this is true. So that's kind of crazy. It's like, so does that mean I should be saving for retirement, or should I be saving for medical bills? I don't really know, but that health savings account helps, I guess, if you can start saving now. And I think even then it's going to be those catastrophic things that happen. But my point with that statistic is just showing how important it is to kind of take into consideration and think about health stuff too. The tax deductible contributions, you do not lose it, unlike the flexible spending account I was talking about. You get to choose to invest in stocks, bonds, mutual funds, so it actually earns money. That's the idea with a health savings account versus a flexible spending account. Tax-free earnings, and you can spend all that money to pay for medical costs. If you don't, say you get to age 65, you're like, you know what, I'm super healthy, I don't need these medical costs anymore. You can pull that money out, but you do incur a 20% penalty plus the income tax, which is a pretty steep penalty, unless you're age 65. So this, I'm going to be honest, I didn't know this existed until this presentation when I did my own research. It's called the Coverdell Education Savings Account. Hopefully I'm pronouncing that correctly, but that's how I'm going to call it. But the idea is it's a account that can be created to save for secondary education costs, such as college, right? Obviously, you can't open it up for yourself if you're already in college, because you kind of already past that point. But you know, maybe you're a parent, maybe you are going to have a family and you are going to be a parent and you want to save for your children. This is a good way of putting money away tax-free or not tax-free, but into an investment vehicle to earn more money to help pay for future college expenses. And it doesn't even have to be college too, but just other education expenses. So this is, you could use this for private schools. You could use this for, yeah, exactly. Private schools, elementary schools, secondary schools, tuition fees, books, supplies, uniforms, all that stuff. And so this is money that you get to put, again, into an account where you can invest in mutual funds, stocks, bonds, so that your money can earn and have more earnings potential, basically giving you more money to spend for college and everything. I don't know, has tuition been going up for you guys? Like, have you seen tuition prices increasing? I'm kind of curious.
I feel like it does.
Yeah,
You feel like it does?
a little bit, especially with housing and stuff. Housing's
Yeah.
probably more expensive than tuition at this point.
Oh man.
Yeah.
I have a question. Like for this Coverdell education savings account, does it affect how much you get for financial aid?
Does it affect how much you get in financial aid?
Yeah, let's just say that you disperse it for your children.
I'm gonna guess no. And that's basically, I'm saying yes, but you know, financial aid I know is based off of compensation or income, right? What your personal income is, as well as depending on your age, your parents' income. So this account, the Coverdell, is a separate trust account that is going to be opened in your behalf by somebody else. So it's kind of like a yeah, it's a trust account. That's the idea with it. So I would guess that it won't affect financial aid. So yeah, it can be a supplement to that. But here, I got a couple more slides on this, so maybe I can answer some more of your questions there.
Another question I have is like, what's the difference between the 529 plan and this Coverdell education?
Yes. So I think the 529 plan, you can't invest in the stocks, bonds, mutual funds because it's government regulated. So they are only going to limit you to certain investment options that they provide you. So they're probably, because of the government, they're going to be less risky on those sort of things. They're going to be like probably treasury bonds, interest-bearing accounts, less risky accounts that really don't fluctuate with the market, where your stocks, bond, or stocks in your mutual funds and new investments that are kind of getting popular right now, these exchange traded funds, ETFs, those are all options that are typically going to be available. And so they have better earnings potentials. That's where you're going to get your 7%, 10%, 20%, depending on market fluctuation. But it also means if the market crashes, your money's going to go down also.
Gotcha. Thank you.
Yep. So who can these trust accounts be open for? Beneficiaries under 18 years old or with special needs. So the fun part about this is you don't need to be related to somebody to open this up. So I can open up one of these accounts for you, Dixon. Like, we don't need to be related. I could be like, you know what, Dixon, I really care about your education. We had a good time hanging out. And so I'm just going to open up a trust account for you.
Oh, thank you, man. I appreciate it.
Right, exactly. And you know what? I can put $2,000 a year away in that account for you.
Sounds good.
Exactly. I like your cloverleaf, Justin. Contributions are not deductible because they are similar to like a Roth IRA, where they're after-tax contributions, meaning I don't get to, even though I'm feeling generous and I want to put some money into that account for you, I'm not going to be able to deduct it on my personal return. So it's really just out of the generosity of my heart, and you know, not really getting any tax benefit. I'm purely just doing it because I want to help you. So there is no limit on how many accounts you can get, which means you can get that account for everybody, or you can get an account from everybody in this chat saying, we're all going to open a trust account for you. But that limit is $2,000 from everybody. So if you have multiple people opening an account, collectively, we can't contribute more than $2,000 into that account a year. When you finally want to use them, the distributions are tax-free, and you're required to use that money when you reach age 30. So if you decide you're age 30, you're like, you know what, college sucks, I don't want to go, that money is going to come out one way or another. However, you're like, you know, Dixon has a brother who also is going to go to college. He's younger. He hasn't figured out what he's doing yet. Dixon can take that money, put it into a trust for a brother, and still kind of keep that tax-free status for a little longer. If you do pull money out of that account early, before you start going to college, you do get a 10% penalty. So all of these accounts, you usually have options of getting money out, but there's always a penalty attached, greater than just being taxed. So that's always the idea for it. It's, you can get the money out, but in addition to your normal tax bracket, you're also going to have a 10% penalty. So it does become very costly when you start thinking about it. You know, your tax bracket could be, you know, low. It could be 10, 12, 15, 20%. Now you start taking these distributions and you're taking them at the 20, 30, 40 tax brackets. All right, so let's talk a little bit more about these specific withdrawals. Like, the whole point of retiring is to get money to us at some point. There are loans, and this is something that I don't think people realize. You can take loans out of your 401k accounts. You can pull money from you and pay yourself back. So you're borrowing from your own future retirement accounts. And we will talk about that in just a second. And there's also hardship distribution, so we'll go into those details. So typically, a loan from yourself is limited to 50% of your vested account balance. Vested means how much you've earned based off of service. So that the vesting is a term when it comes to employer contribution part. So if employer is putting money into your account, you don't get 100% ownership of that employer money until you've worked for them long enough, or $50,000. That is the limit. And these were temporarily adjusted for the CARES Act that passed during the pandemic, but they will go back to this at some point. You can take a loan whenever, doesn't depend on hardship. You can typically take multiple loans. Sometimes it's limited to one. Sometimes they're not allowed at all. It just depends on the company you work for and the plan you're in. It does require you to be repaid. And that's the cool part, is interest gets paid back to you. So instead of taking a loan from your bank, you can take a loan from yourself and you are paying yourself back interest. So I have seen, and it's actually kind of smart. I would say smart, but I've seen like highly compensated individuals in these retirement plans taking $50,000 loans. You're like, why do you need a loan? You clearly make enough money and you aren't having any cash problems. They're like, well, I'm predicting that the market's going to go down. And so I'm taking money out, paying myself, and then putting more money in through interest that I'm paying myself on my loan. So they're using it as a stable investment that they get to pay themselves more money. It's kind of a loophole from what I've seen, but that's why they do things like that. And they are non-taxable unless you don't pay it. And we'll get to that in a second. Your repayments can be 5 years. If you want to purchase a home, you can extend the loan repayment terms out to 15 years. You have to make payments at least quarterly. Typically, they're done every pay period, though, if you're on payroll with the company. And then if you don't make those payments, the loan is called deemed distributed, meaning they don't expect to collect on it, and so you're going to receive a 1099-R, and the IRS is going to tax you for that amount. An IRS definition of a hardship. So an immediate and heavy financial need, and there's no other resources for you to take money out. And so when this occurs, you can pull money out of your retirement account and avoid the penalty that they ask, that they typically require on an early distribution. So what counts as a hardship? You have medical expenses that you can't afford. You're trying to purchase your principal home, you can pull money out and not have to pay it back. Tuition, education fees, you can pull money out of your 401k account. You can't pay your rent, you can pull money out to prevent being evicted. And funeral expenses, money can be pulled out of your 401k account to pay for those. With the pandemic, there was temporary relief. So if you were affected by the coronavirus, you could actually pull money out of your retirement account. And a lot of people did this year. The maximum amount, so you can't exceed the employee's need, and you can't exceed how much you've vested, how much you've earned. So because remember, your 401k account isn't just your money, oftentimes it's the employer's money too. So here's your pros and cons with the hardship distribution. You don't have to repay it, but your cons, you're going to pay those income taxes. And we're all trying to reduce our income taxes. I know we got 5 minutes left, so that brings me to the end of the presentation here. Here's my contact information. I kind of sped through a lot of those areas. Again, it was just a high level overview talking about all the different things that are available out there. I know I didn't know about the Coverdell account, so maybe it's informing some of you about this stuff too. And obviously this isn't all, there's different ways of doing it. I know people invest in real estate and all sorts of different things. So hopefully that helps. If anybody has questions, I'm here for another 5 minutes and happy to help.
Really quick question. When you're talking about the Coverdell and you're saying, you know, how if Dixon doesn't use the money and he could just pass it to his brother, like, do you also have a say in who he passes down to, or?
I don't know the answer to that question, but I would probably say no, because the idea is, I think Dixon would have full control over who he'd want to do that. So the idea is you assign a beneficiary to the trust account, right? So if I'm saying Dixon is the beneficiary, that means he ultimately has ownership and control over that account, as well as probably discretion on how that money gets spent and who it benefits. So if he decides, I don't want to be the beneficiary anymore, and I'm going to transfer it to this person, I'm pretty sure that I have no say in that. That's his decision.
Thank you.
Yeah, I mean, obviously, this is a guess. I haven't done it myself. I haven't read the law or anything. I just did. I mean, I did research on the IRS website, but that wasn't one of the things they said. But knowing how a trust account works, I'm going to guess no, I don't think I have any say.
If there are no more questions, we're really quickly going to take a picture. So Abigail, if you want to take the floor, go ahead.
Hi, everyone. Can you please turn on your cameras if you like, so I could take a group picture with everyone? Give me 1 second. Okay, 1, 2, 3. Okay, I got it. Thank you.
Thank you very much, everybody.
Thank you very much, Scott, for your presentation. So, so as a reminder, on later today from 5 to 6:30, we will have CSUN alumni from different firms. So feel free to join us, and you can ask a lot of questions for CSUN alumni about full-time And on Wednesday, COA will stop in by 12 p.m. to present and talk about their firm, their country, and their industry area. And don't forget to sign up for the AA hiking to the Hollywood side on Saturday morning, 9 a.m. Feel free to relax after the busy season. And that's it for today. Thank you very much, Scott and Professional Convention, to present on our future, help us to understand more about the pension. Thank you, Scott.
Thank you.
Thank you so much, everyone, for coming. Have a nice day.
Thanks.